Tax season is coming up on us, and it's always nice to be familiar. Moreover, not only with the changes, but which accounts are the best for your investments. Well, one big change is a brand new form called 1A. It limits your taxes on tips, overtime, allows deductions on American automobile auto interest, and even gives you an old-timer benefit. Well, most middle-class taxpayers now pay a federal rate of 24%, and Californians pay about 9.3%. Makes the math easy. That's 1/3. Let's start with your personal cash account, which normally is fully taxed, but does have one unique benefit, and that is capital gains and USA qualified dividends get a 9 percentage point benefit. This is in contrast to a typical pension, be it a 401k or a 403b, because there you have a delay, meaning a present value analysis. And if you look at the two side by side, you'll find that those qualified dividends are really only belong in the cash account if you're going to retire very soon. Otherwise, looking at the pension, the delay of the tax is a present value. There's a nice little shortcut called the Rule of 72. So the product, if you have, say, 6% in 12 years, 18 years for 4%, that's where you get a 1/2 tax savings. This is in contrast, in addition to the IRA accounts. That A does stand for arrangements. And the traditional and the Roth. The Roth is tax-free, but the traditional will give you the same return if the terminal tax bracket is the same as the initial one, noting that some states do not. So if you move to those, you'd really be better off with the traditional instead of a Roth. Well, the Roth is tax-free, and it doesn't have to have a minimum withdrawal at the age of 73, as does the traditional IRA and pensions if you're no longer working. Another choice is a health savings account. In California, at a 1/3 rate, it allows you to spend $3 for every 2. And the last one you should consider, according to most experts, is the 529 education. That is state-specific. Well, number 7 and 8 are not exactly what you consider accounts. Social Security and your home. Well, do note Social Security is determined on the last 10 years of work. It's 85% taxed for middle-class payers. It's fully taxed in some states. I listed them here. And the nominal age is 67. Some say delay it. You know what? If you do a 5% analysis, you better take it at 67. Also, you enjoy it. And the final 8th one is your home. Yes, it's a consumption. Yes, it is deductible. But it also is an investment. With a $250,000 for singles, $500,000 for marrieds, one-time exclusion. So doing your last year's taxes, there is one you can do this year, and that's for last year's IRAs.